Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us, former White House Budget Director in the Reagan administration, David Stockman. David Stockman, thank you for joining us today on USAWatchdog.com.
Very happy to join you. Got some important topics we have to get to today.
Well, really, a lot of people, I just want to start right off the bat. You recently said the stock market is overvalued. A lot of people say that. Are we headed for a stock market calamity worse than 2008?
Well, I think we're headed for a central bank calamity. The central banks of the world have been in a 20-year campaign to just massively expand their balance sheet, intrude into financial markets in ways that were never before imagined, and in the process falsified nearly every asset value there is, from overnight money all the way through 30-year bonds, the stock market. Everything now is trading off the central banks, but the central banks have hit the end of the road. They have printed so much money. They have created such a massive global bubble that we're now in the process where that is fracturing, that bubble, and the central banks are beginning to become confused and panicked about what to do. The Chinese have no idea what to do with their 28 trillion credit bubble and house of cards in China. Our Fed is now on the verge of another meeting where they're debating if 80 months of ZIRP is enough, 80 months of zero interest rates. That is crazy. That never should have happened in the first place. And to continue it for 80 months when it's obvious that none of that liquidity is getting to the Main Street economy is really just a measure of how fraught and how dangerous conditions actually are. And of course, when it breaks, the stock market will go for a spill with everything else.
We've been told that debt is money and debt is an asset. This is my saying. We've been told debt is money, debt is an asset. We're going to find out neither is true. I mean, is that right? I mean, these bonds are not assets, they're liabilities, and they're going to be exposed, correct?
That's exactly right. Maybe we could use a number here to get some magnitude to this. Go back to 1995, because that's when I think all the central banks got into this convoy and began to copy each other in this money printing spree. There was 40 trillion of credit market debt in the world at that time, from Europe, the United States, Japan, the Far East, even incipient China. Today there's 200 trillion of debt, a five-fold, 5x increase during a time in which the GDP of the world maybe went up 40 billion. So we've created about 5 times more debt, or 4 times more debt in the last 20 years than real activity in the economy. And even that economy that they calculate today, the global GDP, I think is inflated by a lot of one-time investment in infrastructure and capacity that is way overdone, created a lot of malinvestment, excess investment that will now go into a deflationary reversal. So, you're right. All of that debt did create a temporary boom, but now the boom is ended, or it's reached its limit, and we're in the deflationary payback zone, where I think we're going to have a huge capital spending bust, and that will ricochet all around the world.
Well, this is beyond just deflation. I mean, this looks to me like when you have, we're talking trillions of dollars in bonds that are going to, we can't pay any of that. I mean, this is going to be like a Mad Max scenario, isn't it?
Yeah, and see, that's one of the evils of this zero interest rate policy, what the economists call financial repression. It created such a mad scramble for yield among money managers just trying to do their job and stay in business, or meet their benchmarks. And as a result of that, since they couldn't make any return on sovereign debt as a result of central bank policies, they went further and further out on the risk spectrum, bought junk bonds like never before. There's trillions outstanding now, but more importantly, bought EM, so-called emerging market debt, with their eyes closed. People were buying 100-year bonds from Brazil's national oil company, Petrobras, just 3 months ago in June. 100-year bonds at single-digit interest rates. Now that is and Petrobras is a cesspool of corruption. It's 130 billion of debt. It's falling apart. It is, the core state company of a Brazilian socialist economy that is hitting the wall. And yet, as recently as June, investors were buying 100-year bonds from that kind of, house of cards. Now that's a measure of how distorted the world economy is. And that's why I say the financial system is booby-trapped with debt bombs waiting to explode. I use the 100-year Brazilian bonds, but there's trillions of this stuff all over the place. And, the thing is, the central bankers pretend they don't see any bubbles. These people are not only bubble blind, they're bubble deaf. They have no capacity to understand the explosive nature of the financial markets that they're toying with.
Let's just futurecast here. Do you think the bonds are just going to be unpayable, correct?
Yeah, obviously there is a lot of debt being borrowed in the world. Take Japan. Japan has 10 trillion of debt, 2.5 times its GDP. Its economy is dead in the water. Its population is old and getting older. Its workforce is shrinking. There's not a chance that Japan, as it sinks into the Pacific Ocean as an old age colony and stumbles towards bankruptcy, will ever be able to pay that debt. That's one example. There's many countries in the emerging market world that are the same way. And frankly, how are we going to manage over time? We have 10 million baby boomers, retiring every day. 10,000 retiring every day. How are we going to pay all of that unfunded Social Security, Medicare liability at 75 trillion on top of the 19 trillion or so of public debt that we owe? I think everywhere in the developed world, there's going to be a fiscal crisis over the next 10 years.
If the bonds are assets, and you say, I think you wrote this in your book, The Great Deformation, they're not so much. They're not assets. They're liabilities. Okay. Overall, I'm simplifying your book. I'll put a book buying link to your page, incidentally. People should read it. But if bonds are no longer an asset, which is a collateral, aren't the bankers going to go absolutely crazy looking for collateral, taking property, looking for new collateral, whether it be gold or property or oil or commodity? Aren't the bankers going to say, we need collateral, the bonds are no good? Aren't they just going to be on a spree to take collateral?
Yeah, because, we have daisy chains of collateral that have been created as a result of the very view you've just articulated, that debt is an asset. If it's an asset, let me buy it, fund it on 95 cents of borrowed money, and collect the spread. And then the guy who loaned me the 95 cents says, I've got an asset, let me borrow against the 95 cents, and I'll collect the spread. And this goes on and on. Now, what happens when the financial breakdown comes is there is a great margin call. Everybody says, I want my money back, and I'll take your collateral if I don't get it back. And if I do take your collateral, I will sell it for whatever price I can get and cut my losses. So this is truly a house of cards. The whole pyramid of debt and what we call hypothecation and rehypothecation of financial assets. That's the real bubble. That's what people don't focus on enough. Sure, you can think of stocks that are a bubble, like Tesla is ridiculous at its current price of $250 or so, or the the biotech index, which is trading at hundreds of times earnings, is crazy. But what's really crazy out there is that all of this debt that's been created has been turned into collateral and borrowed against at a very high rate. And the whole thing really is unstable and tottering, really, as we speak.
Isn't there going to, along with the bond crisis, if the bonds are no good, And a bond is a ball of money, as you know. I mean, you're brilliant. And I'm just trying to break this down for my simple mind. And if the bond is a ball of money and if people want their money back, isn't the money going to be corrupted? Isn't that going to go poof as well?
Yes, that's it. I mean, the whole idea that debt has substituted for real money, which used to be what the whole system was anchored to, is at the heart of the crisis that we're facing as we go forward. Because the point is, all of that debt has become collateral, and it's created these chains, as I've indicated, of claims, which, when they start to have the great margin call, will unwind and shrink. That's what people don't understand. You listen to the talking heads, on CNBC or wherever every day, and they'll say, well, it's a zero-sum game. If you sell off some stocks, somebody will buy some bonds. The water level stays the same. That's absolutely untrue. Much of this, collateralized credit that has been created is a confidence game. It is a daisy chain. And when the confidence breaks and they start to unwind the chain, the amount of debt outstanding will shrink. And that will create tremendous, broken furniture in the financial system.
So how would you protect yourself? Do you have clear title house, a clear title land, gold, silver, diamonds, artwork? I mean, isn't that what the rich have been doing when they bought, one of the masters for $178 million? And I was like, why would you pay that? They're just shedding cash. So they're buying real assets. Is that how you protect yourself?
Well, real assets can get overvalued, too. I mean, the reason they're buying this absurdly priced art is it's a good parking lot that's mobile, that it can be stored in a storage place in Zurich where the prying tax collectors of the world can't find it. But the point is, it doesn't mean that these crazy values can be sustained. You may have your art in the storage in Zurich, but it may end up being worth a fraction of what you paid for it. So there's a bubble in everything. When you have too much liquidity, when you have too much credit in the system, people will find ways to bid up almost any asset class they can conceive of and convince themselves that this one is different. This is unique. It's irreplaceable. No one is going to, do another Picasso of this type. And that's exactly true, but it doesn't mean that this inflated value needs to stay the same. So the place to go, in my view, is in cash. Stay short in liquid, because we're going into a deflationary collapse. We're going into a great reset in the financial markets where inflated asset values are going to be marked down tremendously, bond prices, stock prices. And as a result of that, there will be a great opportunity after the dislocation runs its course to buy things much cheaper than their price today.
Well, two questions on that. I mean, if we have these trillions and trillions of dollars in U.S. Treasuries, John Williams, economist John Williams, says we have at least 16 trillion. And if people start trying to cash those out, I mean, the dollar is going to take a crushing hit. So, how do you navigate that landmine if the Fed either the Fed says, well, those bonds are no good, or we're going to start printing money and we'll pay off China and India and whoever is holding these liquid U.S. dollar assets outside the country. What happens to the cash if people want to liquidate their bonds?
Well, I think you have to take a slightly different angle on that. There is a race to the bottom among central banks in the world. And as bad as our Fed is, I think they are even crazier at the Bank of Japan. It's nuts what they're doing. The ECB and Draghi is clueless about the disaster they're creating. The People's Bank of China, has created the greatest credit pyramid in history, and now they're losing control. So I think actually the dollar will be stronger than all of these other fiat currencies.
Even with all the debt.
Yeah, even with all the debt, because the other central banks are going to become even more desperate and unpredictable as a result. So when I say cash, I mean, I think Treasury bills are okay. I don't think the government is actually going to default on 90-day Treasury bills. I think our economy is going to suffer for 10 or 20 years as taxes go up, spending is cut, Social Security is means tested, defense is rolled back. All these things will happen one way or another as the bond market begins to normalize and scare the politicians. But as long as the Fed was keeping interest rates at zero and had a confidence or con game going that all of this could be perpetuated indefinitely, there was no reason for Washington to face these fiscal problems that we're talking about. Now, I think the Fed's at the end of the rope. They may defer, kick the can again this month, but it will not necessarily, except for a short run spike in the market, it will not be convincing. I think there's going to be more and more division, more and more conflict. It's going to scare the markets. They're going to realize that the Fed doesn't have unlimited power to control the world and to create artificial wealth. And as a result of that, we're going to have a day of reckoning both in Wall Street and in Washington.
And you think it might happen this year? I mean, before the end of the...
I think it's going to happen in this election cycle over the course of the balance of this year into 2016. The Fed, can't keep zero interest rates going. If they dare try to go back to QE4, I think they will create a firestorm of fear in the financial markets. It'll be proof that 6 years of this failed, and even the traders who love this kind of money printing campaign will lose confidence and basically head for the hills and sell. And when they start selling, there's going to be no bids. There's going to, as we say, markets go up on an escalator, they go down on an elevator. And when fear breaks, and that's what happened with .com in April 2000, that's what happened on Wall Street in September 2008 with the Lehman bankruptcy. When fear finally sets in and penetrates and changes the short-term confidence factor, the selling starts, and then the Fed now will have no ability to bail out the system like Bernanke thought he was doing last time. When you're at the zero bound, there's no bound, so-called, there's no place to go. After you've already printed $3.5 trillion and you're now heading to another crisis, you will lose the key factor that has kept this game going, which is what I call the con factor. Some people think that they'll be forced into the Fed, be forced into a QE4, a more money printing, either overtly or covertly. What say you? I think very unlikely that they're going to get away with it, even if they start hinting they may try, or even try some variation of it, because I think it will be a absolute explicit repudiation of what they've been doing for the last 6 years. And even though Wall Street and everybody else has enjoyed this great party and this tripling of the stock averages and so forth, rationality hasn't been destroyed completely. And if people see that this whole thing has failed and we're back in the soup where allegedly we were near Armageddon in September 2008, I don't think it's going to, the con job will work a second time around. And last question, you don't think they'll be raising interest rates anytime soon? I know they should raise interest rates. You have said just recently that they're robbing savers. It's a, quote, jihad on savers, you said. Yeah. They should raise rates. Are they going to raise rates? Of course they should raise rates because, the money market is the most important market in capitalism. And if you don't have an honest price that's set by supply and demand, you're going to create huge distortions and a large subsidy to speculation, which creates bubbles, which then sets you up for another fall. So they have been wrong for the last 80 months of zero. They're now at the point where they can't extend it much longer. I think either this time or sometime this year they will raise rates. They have to, you're saying. Yeah, they will have to. in order to retain any credibility at all.
That's going to be a pie in the face on Wall Street. They're thinking that they won't raise rates, and you're saying they're going to have to soon.
Well, the chorus is out there saying defer, defer, defer. The conditions aren't right. We didn't expect China was going to happen. The stock market went down in August. These are really silly, trivial reasons. They're all being brought up, but I seriously doubt whether the Fed can delay much longer.
And while I got you on this subject, I mean, the World Bank and the IMF have warned strongly, telling the Fed not to raise aid. I think the World Bank said it would cause a turmoil if you raise it. We're talking a quarter of a point here. And so what do you say about that? The World Bank and the IMF warning the Fed, scolding the Fed, don't raise interest rates, put it off. What do you say to them?
Well, first of all, these are just Keynesian economists talking to each other. The very same people who urge the central banks to paint themselves into this disastrous quarter that they're in are now saying, don't you dare try to get out. Just dig in deeper. And I think it is so silly that it's hard. It's really a crime, I think, that the taxpayers of the world who are working hard every day to make ends meet are paying taxes so that governments can fund these fools who run, the World Bank and the IMF. The world could do without any of them. And yet, they're allegedly the voice of authority. They're the professional economists. This is just baloney.
David Stockman, let me make sure I get your website right. David Stockman's ContraCorner.com. Is that correct? That's your website?
Yes.
David Stockman, there'll be a link for you YouTube users. You go to the link that I put in the right through. You'll go to the interview page with David Stockman, and his link for that will be on there. David Stockman. Oh, also your book, The Great Deformation. I'll put a link to that. You can find a way to buy that book, which is a great book. Everybody should read it. It's what you just heard, very intricately laid out in a great book, The Great Deformation. David Stockman, thank you so much for joining us today on USAWatchdog.com.
Very happy to be with you.
I hope you come back, sir.
Certainly will.